Interest rates are rising at the fastest pace in history, or are they? Visual Capitalist just released a chart comparing the interest rate rises going on today versus different hiking cycles in the past by the Federal Reserve. And we're going to take a look at number one. Is this true that this is the fastest rate hike cycle in history? And does this matter? What is the impact of how fast interest rates are rising right now versus the past? Economically speaking, most people, when they're comparing two things, are saying, hey, if they print money or take out this debt or raise interest rates or lower taxes, what's always the underlying assumption is something called ceteris paribus. That is a Latin phrase that means all else being equal. For instance, a politician will come out and say, hey, if we raise taxes by just this much on just these people, then we will increase the amount of taxes the government gets by this much. The underlying assumption there is ceteris paribus, all else being equal. But of course, as we know, in a complex system where one action pushes on something else, which pushes on something else, and levers pull on each other, and we have reinforcing feedback loops and positive feedback loops and negative feedback loops, nothing is actually all else being equal. If you make one action over here, that is almost certain to result in second and third order effects that can't be anticipated. And I'll explain exactly why that matters in a few moments. Take a look at this chart by Visual Capitalist on the interest rate hiking cycles in recent US history. This yellow line showing the interest rate hiking cycle from 22 through 23 so far is the fastest that interest rates have risen in recent history. This is over the past 35 years. Now, this video is somewhat of a follow-up, a part two, if you will, of the video from Monday that I did before this video on the 40-year economic cycle. If you haven't watched that yet, I'll link it at the end so you can go get some broader context. But the reason this 35 years is significant is because for the last 40 years, from 2020, starting in 1980, we were in a cycle where interest rates were being lowered, not raised over the long term. But starting in 2020, that's when this rate cycle bottomed, this economic cycle bottomed, and we are now heading into a period of much higher interest rates for a much longer period of time. The next 40 years will likely look very similar to the 40 years that preceded 1980. That was from 1940 through 1980. During that time, interest rates were rising. And so it stands to reason that the interest rate hiking cycle that started in this new cycle would be the highest and fastest rate hiking in the last 35 years, because the last 35 years was a period of time where over the long term, interest rates were falling, not rising. So are there any examples prior to 1980 in which interest rates rose faster than they're rising right now? Of course, let's take a look. This is a chart of the federal funds effective rate. This is the interest rate that the Federal Reserve directly controls, and then all other interest rates past that are influenced by this rate, but not directly controlled. Starting in 2022, the Federal Reserve started raising interest rates from the floor of 0, and in a little over a year, they've gotten interest rates up to 5%. However, one period in which they raised rates at a faster pace was from the end of 1972 through the middle of 1974. In just about a year and a half, they raised rates from 5% all the way up to almost 13%. Okay, but remember what I said earlier about ceteris paribus, all else being equal. There's a couple things that we need to take into account here. Number one, when you go from 0 to 5, you're looking at that and you're thinking, okay, we raised by 5%. And then when you go from 5, like in the 70s, from 5 to 13%, you're thinking, okay, we raised by 8%. The problem is we might be looking at this the wrong way. Instead of just looking at the numbers, you might have to take a look at this as what is the percentage change on the percent interest rate. Here's what I mean by that. If you go from 1 to 5, you are multiplying it by 5. If you go from 5 to 10, you're only multiplying it by 2. So interest rates going from 1% to 5% is an increase of 5x. Interest rates going from 5% to 10% is interest rates only going up 2x. They're only doubling. Yet Yes, you're getting to a much higher interest rate in the end, 10% versus 5%, but the net cost of servicing that debt in that example would be doubling versus going up by 5 times. And here's the other crazy thing that is not even close to being equal between the 70s, when rates were rising a lot faster, and now. It's the amount of debt that we have. Take a look at this chart from longtermtrends.net that shows the amount of debt that the US government has compared to the size of the economy. This is known as the debt-to-GDP ratio. Currently, the debt-to-GDP ratio in the United States is hovering around 120%. That's right around where it was at the peak of debt fighting World War II. But do you notice where debt was during the 1970s when they were jacking interest rates up? The debt-to-GDP ratio is all the way down here at 30%. Okay, so let's explain the debt-to-GDP ratio just a tad bit here. GDP is like the value of the economy. So if you added up everything, the value of everything in the economy, and hypothetically you said we're gonna take all that and we're gonna sell it and just get the cash value of it. That's the size of the economy, and that's what they say the GDP number is. Now, the other portion of this ratio is the federal debt. So you look at how much debt the government has. So if the federal government has a debt to GDP ratio of 50%, that means they could take, hypothetically, half the economy, sell it to somebody else, take those dollars, pay off the debt, and you still have half the economy left over. It's kind of like the net worth calculation for individuals. Take all your assets, take all your debt. What's the percentage ratio between the two? If you took all your assets, liquidated them into cash, and then paid off your debt, would you have more debt left over, or would you still have assets left over? In the 70s, the United States government, again, hypothetically, would have needed to liquidate about 1/3 of the economy in order to pay off all the debt. This is by no means an unsustainable amount of debt. So during that time, taking interest rates from 3 or 4% up to 13%, or after that, taking them from 5% up to almost 20%. That is entirely doable when you don't have a ton of debt. Now, obviously, a 30% debt to GDP ratio is still high considering United States history. In fact, right below 30% is where the United States started off when we had to pay off the war, the Revolutionary War. But we did a fairly good job of that, and around the early 1800s, we got that debt to GDP ratio down to basically 0. And it wasn't until the Civil War that borrowing exploded again. But even at the height of the Civil War, it still only got up to about 32%. And then the US started to pay that off as well, and it exploded again come World War I. Again though, even for World War I, it only got up to 35%. And then we started paying off that debt. But as we know, the birth of the military-industrial complex and the birth of the Federal Reserve and the birth of the income tax all led to a giant bloated United States government that was able to kind of turn this trend around and perpetually start to get into ever more debt after that. Meaning the ceiling of 30% after the Revolutionary War, and the ceiling of 30% from the Civil War, and the ceiling of about 30% from World War I now became the floor, and the lowest we got in the 70s for our debt was 30%. And we've only skyrocketed since. Another way to think about this is look at your personal income and look at how much your debt costs you every month. If you bring home $10,000 in income and you have $1,000 in your debt payments due every month, that is completely sustainable. That's something you can absolutely afford. Even if the cost of your debt doubles or triples for the same amount of debt, let's say the interest rates go up and you're only paying the interest on your debt, you go from paying $1,000 a month to $2,000 a month to $3,000 a month. That would be painful, but it's still doable. Right now, the United States has a debt to GDP ratio of 120%, meaning that if the government could seize the entire economy, liquidate it, get dollars for it, pay off as much debt as possible, they would still have a ton of debt left over. This means the government is highly sensitive to the interest rate on the debt because it's got such a massive debt load. As we can see during 2009 all the way through 2015 and in 2020 through 2022, interest rates were literally at 0. So it's no wonder to me why right around this time the federal debt started starts to explode. It was under $10 trillion in 2008. Since then, the amount of debt the federal government has more than tripled. This is like an individual who sees a 0% introductory APR on the credit card offer, and they're making 100 grand a year, so they go out and load up with $300,000 of credit card debt. It's absolutely idiotic because you know the 0% is not gonna last forever. So instead of just going and getting a little bit of debt that you know you'll have enough income to pay off, you go and load up on a ton of debt that you know absolutely certain you cannot pay off. Now, all this borrowing leads to spending because you're not just gonna borrow for no reason, you're gonna go spend that money. So the government borrowed all this money, spent it, and starting in 2021, we started to see the results of that, which was massive inflation. Prices started kicking upwards and the Federal Reserve suddenly realized, hey, we've started throwing fuel on a crazy inflation fire by keeping rates this low and by monetizing the debt. And so we need to start jacking up interest rates to stop the inflation. So starting in 2022, they started jacking up interest rates at the fastest pace in recent history. It's nowhere near as fast as they were raising interest rates during the 70s. But no matter how you measure it, we have way more debt today than we did back then. And the vast majority of the debt that we do have right now, when I say we, I mean the government, was borrowed at rock bottom interest rates, which means that even if the Fed stops raising rates, which they are very unlikely to do, they've signaled that they will probably continue to keep on raising rates. It means the cost of the current debt will continue to go up because every time some of their old debt matures, they have to pay it off. That means they have to get new debt in order to pay that off. So they're paying off 1%, 2% interest rate debt, but they're borrowing 5% debt in order to pay that off. So even though we can find times in history, like in the 70s, when rates were rising faster, it is much more significant now because you're making a much larger debt burden, much more expensive, much faster. So what are the results of this? What will break? Because ultimately we know something's gonna break. You can't just start banging your head against a wall like this and expect not to get a concussion. Well, number one, we have crowding out. And that means that the federal government is considered a much safer borrower than anybody else because they have the monopoly on violence behind them. They can get whatever money they need to pay off their debts. And so me as a saver or a lender, if I'm going to put my money somewhere and I can get 5% loaning it to a company that might go bankrupt, or I can loan it to the US government at the same rate, I'm gonna choose the US government because I know I've got a higher certainty of getting my money back. The higher the interest rate the government has to pay on its debt, the less money available for the private sector. Private sector is the one that creates wealth. The government is the one that redistributes and in the process destroys some of that wealth. So the higher interest rates go, the less wealth the economy can produce. If this keeps up long enough, eventually you get bankruptcies, you get companies shutting down, you get stock market crashes, you get widespread unemployment. Now, the big question mark is, will it actually last that long? We don't know. But if we keep heading this direction, that is what's at the end of the line. The next result of this is that eventually the government can't afford its expenses anymore. Imagine if you were that one who made 100 grand, but took out 300 grand in credit card debt and it was 0% at first. Your minimum payment was, I don't know, $1,000, and then suddenly it resets to 20%. And now your minimum payment is, I don't know, 50 grand a month. You probably wouldn't be able to afford that on a $100,000 a year salary. And so you'd be left with the choice of just defaulting or trying to borrow new debt in order to pay off that debt. And in all likelihood, there's not going to be many lenders out there that are going to want to lend you extra money to pay off that old debt because you've proven yourself a not credit-worthy borrower. In the US government's case, we keep on going in this direction. That's absolutely where it leads. Eventually, they get to a point where just paying the debt is such a large expense for them that they can't find borrowers at any interest rate that they could afford in order to pay off that old debt, which means default. Now, again, the question is, will it go that far? And my answer has always been no. That either the Federal Reserve steps in with yield curve control, which means that the government gets lower interest rate borrowing, but nobody else does. So debt monetization, quantitative easing, maybe the Federal Reserve Act is rewritten if the Federal Reserve doesn't want to do this so that they are ordered by Congress to monetize the debt. That's always possible. And as we get into this phase of history, you can see the same thing has happened in many countries throughout the last couple hundred years. You usually do see a merger between monetary and fiscal policy between the central government and the central bank. So it's not unprecedented in world history. No matter how it happens though, I do think we see some sort of a printing over that expense issue so that the debt no longer is debt. We just get inflationary financing instead of debt financing. Two announcements I would like to let you guys know about. Number one, I'm going to be speaking at the Silver Symposium. The Stock Pulse Silver Symposium is going to be a fantastic event. Going to have a bunch of great speakers, and there will be plenty of opportunities for me to meet you, hang out with you. I'd love to get a drink with you. I'd love to see you there. I've got a discount link in the description below for you, and everybody who attends will get a 1 ounce silver coin. It's happening September 29th through October 1st in Las Vegas. Again, I'd love to see you there. Sign up with the link below. And second, the reason why I started Heresy Financial University is because I know what it feels like to not be able to fall asleep at night because of financial insecurity. Whether that's too much debt, whether that's not enough income, not knowing how you're going to pay the bills, not knowing if you're going to be stuck in that dead-end job that is miserable for the rest of your life, never being able to escape the rat race. I've been there. That's why I spent the last 10 years studying how money works. Became a stockbroker. I learned every single angle that I could about how money works, how investing works, how the economy works. That's why I eventually left and started Heresy Financial, so I could share every single thing that I have learned with you guys about how money works so that you can make more, keep more, and give more. And many of those topics are hours long. You have to put in a little bit of work. It's not something that you can cover in a 15-minute YouTube video. That's what Heresy Financial University is. It's my membership program where you get access to my entire training library of material, where we do extremely in-depth deep dives on things like portfolio allocation, fundamental analysis, investing during bear markets, getting out of debt the proper way, advanced professional level option strategies, and more. And anytime, every time I come out with a new lesson and a new course, members automatically get access to everything. Like I said, I know what it's like to not be able to fall asleep at night because of financial insecurity. And that's why I've created Heresy Financial University to help you avoid the time and mistakes that it costs me to be able to get out of that. As always, thanks so much for watching. Have a great day.